Let me ask you something. Have you ever wondered why a single number, like a monthly inflation report, can send shockwaves through global markets? I mean, we're talking about CPI data here, right? That's not just a statistic, it's a financial earthquake waiting to happen. And if you think about it, the July CPI report isn't just another data point, it's a litmus test for everything from Fed policy to your retirement portfolio. What makes this really interesting is how people treat CPI like a sacred oracle, yet few actually understand what it really means. Personally, I think most investors are chasing the headline number without realizing how much of the story is buried in the details. Like, for instance, when you hear inflation is cooling, do you know what that actually implies for bond yields, stock valuations, or even your mortgage rates? Spoiler, it's way more complicated than you think. Let's break this down. JPMorgan's take on the July CPI report? Well, they're probably not just scribbling numbers, they're trying to predict how traders will react. But here's the thing, markets don't care about what the number is. They care about what it suggests about the future. If the CPI comes in lower than expected, does that mean the Fed will pause rate hikes? Or is it a sign that the economy is slowing too fast? I've seen so many people get tripped up by this binary thinking. In my opinion, the real magic happens when you start asking, what's the narrative here? Because that's what moves money. And let's talk about the psychology of it all. Imagine you're a trader staring at that CPI number. Your entire day hinges on whether it's a buy or sell signal. But what if the data is mixed? Like, core inflation is down, but energy prices spike. Suddenly, your strategy is a jumble of conflicting signals. What many people don't realize is that the market isn't just reacting to the data, it's reacting to expectations. If the number is exactly what everyone predicted, the market might barely blink. But if it's a surprise, even a small one, watch out. That's when volatility turns into a rollercoaster. Now, here's a detail I find fascinating. JPMorgan's analysis probably includes scenarios, like if CPI beats estimates, or if it misses. But what they're not telling you is how much of their model relies on historical patterns versus current sentiment. Because let's face it, the economy isn't the same as it was in 2019. We've got AI-driven markets, geopolitical risks, and a generation of investors who've never seen a recession. This raises a deeper question: are we using the same tools to predict the future that worked in a different era? If you take a step back and think about it, the CPI report is just one piece of a puzzle that includes employment data, consumer confidence, and even the weather. But the way we obsess over it? That's human nature. We want to feel in control, and data gives us that illusion. Yet, the truth is, no single report tells the whole story. What this really suggests is that we need to stop treating financial markets like a game of chess and start seeing them as a complex ecosystem. Because in the end, the July CPI report isn't just about numbers, it's about how we choose to interpret them. And that, my friends, is where the real action lies.